And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Thursday, the second best day of the week. That also means, unfortunately, Michael Leibowitz joins me this morning. Just kidding. Just kidding. We have a lot to get into this morning. We're going to talk a little bit about debt to GDP ratios and deficits and kind of a lot of the, kind of address some of the memes running around that, the world's going to end because of all these different situations. So we're going to talk about that this morning with you. A little bit more detail, trying to get some reality put around where we are at the moment and what it looks like going forward. None of it's good, by the way, but we'll kind of get into that and then what that potentially means for markets as we go forward. Today we have some economic data coming out, jobless claims, etc. Recently, if you take a look at the economic surprise index, it's been rising. Inflation expectations have been going up here recently because the economic data has been coming in stronger than expected. But that's the key term here, stronger than expected. And you have to pay attention to the surprise index and understand what it really represents. And what it represents is that economists are wrong most of the time. And what I mean by that is they say, okay, I think economic growth is going to be X next quarter, and then it comes in weaker than expected. So the index of surprises, right? They were surprised to the downside. That declines because they're overestimating what the actual strength of the economy is. Well, as human beings, the thing that we do is that, well, I was wrong last month and I was wrong the month before. So, maybe it's gonna be weaker this next month. So they start to psychologically ratchet down their expectations, and then the data comes in better. And so the surprise index starts to rise. So when that happens, right, other the bond market, the stock market, everything else kind of responds to that surprise index. Oh, things are better than expected, so that means, the world's getting better. Not necessarily. It just means the economists were wrong, and now the data looks better than what they were expecting. And so the surprise index is rising. Well, we're now getting up back to levels where we're about to start getting disappointed again. Analysts are really ratcheting up their expectations for next year. Bank of America just came out yesterday. They're expecting 13% growth in earnings next year. Now, that's important because the average long-term over the last 24 years, right? Just call it 125 now because we're almost done with the end of the year. Over the last 125 years, earnings grow at about 6.5% on average. So B of A is expecting next year that earnings will grow double the growth rate of the long-term average. And the reason that that's important is that earnings are a function of economic activity. So in order to have 13% growth next year, you're going to need really, really strong economic growth. So you're talking about economic growth somewhere in the 3.5% to 4% range all next year, which is probably a bit higher than what's going to actually turn out to be as, again, we have these other overhangs for the economy, the debts, the deficits, those type of things that are going to weigh on economic growth. Deficits are deflationary in nature and they suppress economic activity. So again, what's happening here is that we've had all this economic monetary stimulus that was shoved into the economy a couple of years ago that's still kind of churning through the system. And everybody's now starting to assume that the economic data we're seeing is now natural. That's now normal because of just this is how the new world is. We've just gotten this. But they forget about all those trillions of dollars that are out there still sloshing and working their way through the economy. And that is fading, as we see as with personal savings rates, et cetera. We're starting to see more and more individuals living paycheck to paycheck. In fact, there was a study out by Bank of America yesterday, or day before, I can't remember. But it shows that 20% of Americans making $150,000 or more are living paycheck to paycheck. That's not the type of data that you want to see that suggests rather strong economic growth into next year. So again, just kind of keeping that in the watch. But we'll talk some more about some stuff like this morning. But let's talk about what you need to know before the bell. So yesterday, we've been talking about this rising wedge pattern in the markets, and we've said, hey, kind of keep a watch on this because it kind of determines where the market heads to next in the short term. And this rising wedge pattern is simply a function that we have this kind of rising bottom that's going, and then this compression of price along the top. So we kind of discussed this with you yesterday and said kind of watch this because we're starting to kind of work this angle. So a break to the downside typically suggests you're going to have a bit more of corrective action when that occurs. Well, yesterday we broke down through the bottom of that rising wedge pattern. Now, the good news is that we came down and tested the 20-day moving average and held onto that. In fact, the market kind of broke through it temporarily, rallied back above it by the end of the day, holding that 20-day moving average and closed basically right at it yesterday on that 20-day moving average. So the first level of support is holding for the markets. The next level of support is going to be around 56.50, which is the 50-day moving average. So there is risk here of a bit more of a correction as we head into the election. And that really isn't surprising. We've had a lot of Wall Street betting just recently on tech stocks, financials, et cetera, kind of that Trump trade that we've talked about here recently, kind of all piling into that right here ahead of the election. Well, there's no guarantee that Trump's going to win the election, so it won't be surprising to say, well, maybe I'll take some chips off the table. It's been a nice trade here over the last 6 weeks. I've made some good money. Not sure what the results of the election are actually going to be, so maybe I'll take some of that money off the table and just kind of put that on the books for right now, and then we'll see what happens after the election. So again, this is kind of potentially what's happening here. We may see a bit of a rotation in the markets out of some of those kind of those trades that we saw going in. The market pulls back here a bit to support, and then potentially we'll be past the election at that point. And then we're going to get buybacks. We're going to get, kind of new policy positions put on depending on who actually won the election, how it turned out. Also, too, more importantly than the presidential election is who wins House and Senate. That's going to be the bigger determinant because that's really going to affect whether or not any policies get passed or not. But going into the year, we still have a lot of catch up to do. Managers are a lot of managers are behind on performance this year. They've got to play catch up. So there's going to be a chase for equities heading into year end. But again, this kind of correction process here first won't be surprising. Yesterday, we also triggered a MACD sell signal. And again, we talked about this on the show yesterday. This is that buy signal that we talked about during our technical analysis review yesterday on the show. But we did trigger that sell signal on the MACD from a fairly high level. So again, just another kind of positioning with relative strength declining and still not oversold yet. So this market does potentially have some more downside. However, saying that won't be today most likely. We're likely going to see the market move to the upside today. Tesla came out yesterday, just killed it on earnings. The stock's going to be up about 12% today. Well, that was kind of pre-market last night. I think it's up around 10% right now. So we're going to see a big pop in Tesla this morning. That's going to probably lift a lot of the tech sector with it. So the NASDAQ's going to be up a good bit today. Again, Tesla's a big component in the NASDAQ anyway, so that's going to kind of lift the whole market there. That should probably feed over to the S&P. And again, we've had about 3 days of sell-off here. So again, won't be surprising to see this market rally here a bit today. Try to get back to the bottom of this rising trend line. If it fails there, turns back lower, that's going to be kind of your key indicator that we're likely going to have a bit more correction. If the market just moves right back to all-time highs, then that little correction is over and it was a buy the dip opportunity. So the next couple of days will be very telling as we wrap up the week, and of course we'll keep you updated on it every day as we kind of go along. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz and talk about debt, GDP, deficits, all of the bearish porn that's out there. We're going to cover it this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Sure. Pause it. Okay. Brent's having problems over here this morning. All right, welcome back to the show this morning. Manager, you were gone 8 hours to smoke. Me, it was a brisket. Only in Texas. So, talk a little bit about markets and elections, and of course, all this, that's been going on. And Michael Leibowitz has a new article out this morning called "Memory Hole Inflation." A lot of, yields have risen here lately, and we had talked about this back September the 17th. We wrote actually the day before the Fed meeting. Michael and I were discussing in our daily market commentary that, the surge in bond prices and the sharp drop in yields had gotten very, very overdone. We were about 4 standard deviations below the moving averages, et cetera. And that the Fed announcement could very well likely be kind of a buy the rumor, sell the news type story. And that's what it's turned out to be. And now, as rather than just understanding the kind of the technical dynamics of the market, that, now that yields are rising, unsurprisingly, you're getting a whole lot of analysis coming out from people. It's like, oh yeah, yields are going to keep going up because of inflation, or it's the debts, the deficits, all these type of things. So again, what we try to do as investors is we try to rationalize why something in the short term is happening, but not understanding the long-term dynamics that kind of go behind these things. And again, things wiggle in the short term. And so yes, there's, when things are very overbought, they're going to correct. When things are very oversold, they're going to go in the other direction. And that's just the way markets work. Nothing goes straight up or goes straight down. But trying to imply a short-term move into a long-term dynamic is a very different idea. And again, we kind of go through these gyrations in the markets. It makes great headlines, right? Gets lots of clicks, lots of views. Whenever you start, publishing out any type of thing where, it's the debts, it's the deficits are exploding, we're all going to die, and it's all, we're all going back into the Stone Age, is always an interesting story. And, it makes great headlines, it makes for great stories, but again, you have to look at the underlying economics of how things actually work. So we're going to kind of go through some of that with you this morning. But Mike, let's start with your article yesterday, which is on the website right now at realinvestmentadvice.com. So, just kind of encapsulate, what is memory hole inflation and how's that impacting things right now?
So memory inflation, I guess it falls under the PTSD studies. And it's basically when we as humans kind of exaggerate or inflate our memories of the past. And in the case of PTSD, it's a traumatic event. And a lot of PTSD victims are actually, they feel that event was even worse today than it actually was in reality. And when you think about it, we have memory inflation about everything, good and bad, right? College was the greatest 4 years of your life. Every day in college was great. That's not true. There were a lot of crappy days in college. There were, just you can go back at life, and in hindsight, everything seems different than it was. And I think there's memory inflation of inflation. And, you could play a lot of games with the title of the article, but the concept is that we still have PTSD isn't the right word, but some distress over the inflation that we witnessed a few years ago. I mean, it was something that most of us in our lifetimes hadn't seen, and even like old guys like Lance and I, since we were kids. So we saw the gas lines, but we weren't really paying for the gas. So it didn't really hit us as nearly as hard as it did this time. So, and I feel like my opinion is that that's leaking over into the bond market, that we're so scared that the inflation boogeyman is going to come back, and that we're now bound for inflation, that something flipped in 2020, and that now we're on an upward inflation trajectory. The prior 40 years, inflation was going lower and lower for a number of good reasons. So, we always ask ourselves, are those good reasons, those fundamentals, the slower economic growth, the lower productivity growth, are they still intact? And if the answer is yes, well, then those factors that truly drive bond yields, inflation and economic growth, are still the drivers. But we have to deal with human emotions and behaviors. So that's kind of where the article gets to, and kind of talks about how to think about inflation like an economist and not like a human being, which, we all have that problem.
Yeah, exactly. Well, and again, as we talked about before, inflation has a historically very long correlation to economic growth, wages, and interest rates, and they're all tied together. They all respond off of each other. So again, a lot of the analysis that we see right now is trying to tie inflation to things that don't normally drive inflation. A good example of this is the deficits, and it's like, oh, well, the deficit's increasing. Well, actually deficits as a percent of GDP has actually declined a lot. But deficits long-term are disinflationary. In fact, if you just take a look at the deficit versus inflation, as the deficits were growing, inflation was slowing, because the more deficits you have, the more debt you have. The more debt you have, it diverts productive dollars, things that you could use for productive growth, into debt service. And that's one of the key things that comes up. It's like, oh, the interest on the debt right now is larger than the military budget. Yeah. And that means all that money that could be used for building out infrastructure or creating economic activity or doing a whole variety of things that would be beneficial to the U.S. economy is being diverted to make interest payment to the people that own all the bonds. And, they're making a lot of money from all the interest payments, but it's not getting put into the economy. So that's disinflationary. It leads to slower rates of economic growth because you're diverting productive dollars into non-productive uses.
That's right. And, the other part of this whole equation is it's all relative. That prices are up, inflation is up, debt is up. There is more debt outstanding, but it's all relative, because you have to look at our incomes and the size of the economy. And that's where I think a lot of people drop the ball. it's easy to say that the price of a new car is now 60,000 as opposed to 40,000. But your salary has also increased in most cases by a similar amount. I know some people are lower, there are a lot of people higher, and there are certainly retired people. But on average, wages have more or less kept up with inflation. So yes, a car or a gallon of milk, I don't even know what a gallon of milk costs, but let's just say it's $8 and it used to be $5, but you make more per hour than you used to. I actually posted a graph in one of our commentaries that groceries per hour of worked have been declining for the last 30 years. So I know the price of groceries have gone up, but the amount we have to work on average for those groceries is declining. And that's, it's not, no one ever looks at it in that light. Right. It's always, carrots are now $3 a bag.
Right, but that's memory inflation, right? We remember
exactly.
We remember that 2 years ago or 3 years ago, a dozen eggs was, $1.50 a dozen, and now they're $4 a dozen. So we go, well, why have they gone up so much? There's a great, if you go to Cracker Barrels, back in the day, I don't know if this is still at Cracker Barrels, but, or Stuckey's back in the day when we used to travel on Stuckey's. You go into either a Stuckey's or into a Cracker Barrel when you were traveling around, and they would have these book racks. And on the book racks were these little books for each year of the going back to like the 1920s, and you could say, okay, well, you could get a book for like 1937, and you could open it up, and it would show you events that happened in 1937, et cetera. It would also give you the price of things in 1937. So a dozen eggs in 1937 was a nickel. Today they're $5 or whatever they are today. So if you look at it, that was like, look at the inflation of eggs. But to your point, back in 1937, the average wages were like $2 a week. So,
right.
It's, wage growth has grown a lot. Economic prosperity has grown a lot. And because economic growth is growing, prices are going to rise because companies are producing things. They're having to pay more in wages. They're having to pay more for equipment. They're having to pay more for, regulation, more in taxes, all these type of things. Well, that has to be passed on to consumers. And that's all fine because as those prices rise, again, to your point, we're making more wages, which have to come back into the prices of the goods and services that we're selling. So they should be rising if the economy is growing. If the economy is not growing, then that means prices aren't rising, and then you got problems, right?
Right.
So, but again, to your point, all we reflect on is what was the price of bread last week versus this week, and that's, this massive inflation. And a couple of years ago it was bad because we sent checks to households, we shut down the economy, and you're going to get inflation. Question is that going to be the case going forward? Is inflation still going to rise? Absolutely. We are still going to have inflation going up at 2% a year, 2.5% a year, whatever this thing settles out at. Inflation is still going up because the economy is still growing. The real question is what is that rate of growth going to be in the future? Is that going to be stronger or weaker? And we'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
And I've told you before about my dogs. They're 28 pounds. So I've got one that's half German Shorthair Pointer, half Terrier. The other is half Terrier, half Ashani.
The Real Investment Show podcast.
Little brown one. He is solid muscle. I mean, when he just sits still, his muscles are flexing and rippling right through his body. He's very muscular as a dog. Surprising me how strong that little dog is. So I now have new motivation at the gym.
Yeah. Same show, your schedule at realinvestmentadvice.com.
When I go to the gym, I have a picture of that dog because I want to look like him.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, welcome back to the show this morning. So, a couple of things going on right now. And again, I'm getting this a lot in chat right now. So, by the way, if you happen to be on our chat, be sure and smash that like button. We appreciate it. I'm just going to quit asking you. I give up.
Lance, can I comment on a few chats too?
Yeah, sure. But no, actually, let me just set this segment up real quick, and then you can have your way with it. So, in the chat, quite a few people talking about recent comments by Paul Tudor Jones. There were recent comments by Stanley Druckenmiller. Comments on watch people like Lynn Alden and Luke Roman. And, because, they're commenting on, debts and deficits and, this, coming inflation and the end of the world, et cetera, and why you should be hunkered down and, basically a bunker. It's fine, right? Everybody's got an opinion. We have our opinion and they have their opinion, and it's great. That's what makes a market. So first of all, it's not saying that anybody's right or wrong, but, there are situations, and like we're talking about now, that simply don't bear out the truth in terms of what happens. And all you have to do is sit down for 5 minutes and pull a chart of GDP, pull a chart of inflation, pull a chart of debt, pull a chart of deficits, pull a chart of wages, and it doesn't take long to figure out where the economy's headed. And with that goes wages, goes inflation, goes everything else. Now, it doesn't mean that you're not going to have some inflation, because you will always have inflation. But, there's a chart running around right now. It's like, oh, this is like the 70s, where you had the surge of inflation, interest rates came back, and then they took off again. Inflation came back, and then inflation took off again. Well, this chart's been running around. It's a major chart crime on multiple levels, but there's also differentials that's going on that we don't have today. We don't have an oil embargo running around. The Fed is not hiking rates. They're now cutting rates, which is different than it was back then. If the Fed was hiking rates right now, then we'd have a little bit different story. We could be talking about potentially higher yields, higher inflation short term because the Fed's needing to hike rates to quell inflation. That's why they do that. The Fed's cutting rates. But again, we have to look at the data, not just spin headlines that sound good simply because either, I've got a short position against bonds that, I'm trying to make good on. And again, these are short term. For guys like Paul Tudor Jones and Stanley Druckenmiller, these are short-term trades. If yields rise some more, which they possibly can, no doubt about it, they'll be out of that bond trade. They're not going to tell you they're out of that bond trade, but they'll be out of it. And then they'll be long treasuries again. They'll go back and forth, right? So make sure that you don't extrapolate a short-term thesis for a long-term outcome. Those are two very different things. Mike, go ahead.
Yeah. Well, two things. First of all, I saw a lot of commentary, wages haven't gone up and inflation is soaring. Well, the fact of the matter is, since the day before COVID, starting January 2020, median wages are up 22% and CPI is up just a hair under 22%. So on average, wages have kept exactly up with inflation. We can debate all day about whether the government data is correct or not, but the fact of the matter is that they're more or less moving in line. So relatively, we are not better off. We are not worse off. Now, again, I know we're going to get a lot of commentary that inflation is really much more, and the fact of the matter is, no, it's not. Because if inflation was a lot more than what's being reported, if it's 10, 15%, like some people say, well, the price of cars would be $150,000 by now. Going out to dinner would cost $500. And that's not the case. So, and this is kind of odd for me to stand up for the government because I think their reporting is pretty crappy. But the fact of the matter is that on average, again, there's winners and losers in the game, but on average, we are just as well off today as we were in late 2019. And you can fight me on that. You can, let
me just read to you. So right here. Pay is absolutely not increased equally with prices. That's gaslighting with Soviet quality statistics from our chat.
So now can I get on to Paul Tudor Jones and Stanley Druckenmiller? Let me tell you how they work. They are traders, and they are the best. They are among the best of the best. They have had some incredible trades in the past. They've also had some incredibly large money losers in the past too. But they're traders, and they may be long-term investors, but they're traders. And when you look at the market through their eyes, and even, Lance put out a great commentary a couple of days before the Fed meeting. He said it doesn't matter if the Fed's going to cut rates because technically bonds are so overbought. Most likely they're going to sell off, and it's going to be a buy the rumor, sell the fact kind of moment. And sure enough, it was. So let's pretend Lance has billions and he's known around the world as the greatest investor ever. Well, what do you do if you're Lance? You short bonds. So you short the 10-year bond at 380, and it starts trickling up for all the right reasons that were working for you. Well, you're still short bonds. Maybe you're even adding to the position. So now you use your media fame. Hey, I'm short bonds. I think the worst is coming for bonds. Now bonds keep trickling up because if Paul Tudor Jones or Stanley Druckenmiller or Lance Roberts says something is going to happen, they're always right. And what's happening at that point? They could still be short bonds. They could also be getting out of bonds. Mm. They want the yields to keep rising so they can keep slowly getting out of bonds. They don't have to worry about liquidity problems because there are plenty of people that are pushing bonds higher now for them, and they're slowly getting out. And I don't know where they stand, but it wouldn't surprise me if they're out of their positions. And to tell you the truth, it wouldn't be shocking if one of the two of them has actually started establishing a long position, because they both understand economics. They may have some trepidations around the election, and look, that's fine. It's 2 weeks. It's a week and a half, whatever it is. You're selling or buying a 10-year bond. That has implications for not just who's president, but an incredible number of factors, of which all point to flat to lower yields over time. So, you have to be careful about listening to anyone telling you about their investments and what they're doing, because if they're big enough and they have that media sway, they will sway investors to helping them out.
Right. Look,
and they're not going to tell them, hey, I think I'm going to sell tomorrow. It's, you should probably get out of this position now. Do it in front of me. That's not the way it works.
Well, look, and again, when you have billions of dollars, look, Ray Dalio is the same way. $160 billion hedge fund, when he used to run it, would do the same thing. He would write articles, make comments, etc., that he was basically trading against his own position in a lot of cases to make money. George Soros is famous for this, right? He's and love him or hate him, right? A lot of people hate George Soros, but brilliant trader. He has used his personal ability to sway markets, to influence politics, to influence outcomes, to make money, and that's what that's what they do. So just the point is that you have to understand that everybody has a bias, and when you're managing billions of dollars, and you have the ability to position yourself and use that position to make money with it, they're going to do it. But they don't have to tell you when they're out of that position. If you go to simplevisor.com, by the way, we have in our analysis under do-it-yourself research, we have what's called the super investor section. And in that section, we have probably 30, 40, 50 different major mutual funds, major investors, Warren Buffett as an example. And every quarter we collect all their 13F holdings and we publish their portfolio. So you can look at Warren Buffett's portfolio and see what he owns for the quarter. But here's the trick to this. It's for the last quarter. So it's what he owned last quarter. It's not what he owns now. And so in a quarter, we'll get his new holdings on his 13F, and we'll find out that, that position in Bank of America that was, 12% of his portfolio, he didn't tell you that he sold off the majority of Bank of America. It's now whatever it is, it's 4% of the portfolio now. Well, you're still holding Bank of America because you thought he was long Bank of America, and you find out that he was selling it for an entire quarter. You've got to be very careful with, people in the media and understand why they're saying things. And particularly when it comes to like precious metals, these guys are the worst, right? Because you'll hear these guys go, gold's going to 10,000 because of A, B, or C, and then sponsored by some gold provider, all right? And it's okay, but they're trying to sell you a product. So again, as we've always talked about before, don't listen to me and Mike, right? We're just here, telling you what we think, right? We're not trying to sell you anything, but we're just telling you what we think. But just do your own research, do your own homework, and just realize that everybody has a bias, either mental or financial, and you just have to make sure and just say, well, just because this guy's famous and makes a lot of money, I want to trade just like him. That's not going to always work for you in a lot of cases. Stanley Druckenmiller's been wrong. He sold NVIDIA way too early. He even admitted that. He said, I sold it too early, right? So, you got out and you missed a big run because Stanley Druckenmiller got out. Everybody's wrong from time to time. But importantly, like Mike said, these dynamics change and you won't know about it until way too late. But when we come back, we're going to talk about a couple of other things and just kind of wrap up the show for today. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Medicare open enrollment is underway. If you need Medicare insurance coverage, RIA Advisors can help. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in lost benefits and penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that's right for your lifestyle and budget. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show. So just as a comment on trading, etc., and whether you're Stanley Druckenmiller or Paul Tudor Jones or Michael Leibowitz or Lance Roberts, again, you have to do your own thing, right? You have to make your own decisions, trade your own portfolio. That's what you have to do. And if you don't want to do that, then yes, go hire somebody to do it for you, right? And they'll make those decisions for you, right, wrong, or indifferent. But that's a decision you have to personally make. But, just to a point, both Mike and I are now counter-trading Druckenmiller on this particular issue because technically bonds are extremely oversold on multiple levels. Can they get more oversold? Absolutely. We may not be at the bottom for bond prices just yet in this particular downturn, but we're now pushing well into 3 standard deviation territory from moving averages and things that we talked about on the show yesterday. Is if you haven't seen our show yesterday, we spent 45 minutes yesterday going through the basics of technical analysis, right? And so based on the technicals, 20-year treasury bonds, the TLT, is extremely oversold. And you're going to get a bounce. Now, whether that bounce comes before the election is probably unlikely, just because of where the market's positioned. But after the election, probably into the end of the year, you're going to see just a technical bounce in bonds. Nothing more than that. You've got a big short position on bonds. So anything that comes out, weak economic data, whatever it is, it's going to cause shorts to cover. Bond prices go up, yields come down. And so I told y'all on Tuesday that I've taken on a personal position on that in my own personal portfolio. We wrote about it in our daily market commentary yesterday. So it's published. And I've got some call options for the end of the year. Mike did a different type of trade yesterday, but kind of the same analysis that when you look at the technicals, it's extremely oversold and you're going to get a bounce. That has nothing to do with where inflation is going to be in the next month, 2 months, 6 months, a year. Has nothing to do where economic growth is going to be. Has nothing to do with the debts, the deficits, nothing. It's just simply technical. Prices get too oversold on one side, you're going to get a bounce. Markets go up and down. They don't go in a straight line. So anyway, that's the whole point. And that's the same thing as Mike was saying, just to wrap that whole conversation up, is that's the same thing with these big traders. The difference is that Mike and I will tell you when we're out of our trade. So when I close that position out, I will tell you on the show that I closed out that position, right? Because we always want transparency with you. Everything that we do on the show is that we always want to be real transparent with you, like saying, hey, this is what we're doing. This is where we made money. This is where we lost money. So you have an idea as you're managing your own money that, stuff happens sometimes, right? So transparency is very important. Anyway, so let's shift gears here real quick. Bunch of economic data out today, and again, we'll kind of see this over the next couple of weeks. We're starting to move back into kind of an economic reporting season. This week, lots of earnings this week. Next week is all the big boys. So Apple, Amazon, Microsoft, Google are all going to report next week. Tesla was last night. They reported important numbers. But by the end of next week, we're going to have about 80% of all businesses, all the big S&P 500 companies will have reported earnings by the end of next week. So we'll have a really good idea about the strength of earnings season, just how good it was. And I think what we're going to start to see is a fairly rapid revision in some of these forward estimates that we're seeing for earnings going into 2025. We saw quarter three get ratcheted down pretty well. I think we're going to start to see quarter four getting ratcheted down also. But once we start next week, we should also start getting some retail earnings numbers as well. And that will kind of give us an idea of just how strong the consumer is going into kind of the most important season of the year, which of course is November, December, Black Friday, which started 6 months ago, and then Christmas. So, Mike, any kind of comments so far about what you've been kind of noticing?
Well, Starbucks yesterday caught my attention. And I focus on Starbucks because it's a cheap luxury. It's something we can,
I don't know if you call it cheap.
Quote unquote. What's that?
I don't know if you can call it cheap.
Relatively cheap. But it's something, for $4 or $5 you can buy yourself, you feel like you're treating yourself a little bit. It's not going to necessarily break the bank. So I think it's a barometer of consumer confidence. And, when you're feeling good, great, I'll go get that cup of coffee every day and treat myself. And when you're worried about things money-wise, job-wise, maybe I'll cut back on Starbucks. That's an easy way to cut back. So I just think that Starbucks is a good barometer. And their sales declined. Same-store sales in the U.S. were down 10%. Overall, their same-store sales were down 7%. That's a big deal. Now there's competition. There's other factors that affect Starbucks. It's not just people are necessarily spending less. There's all kinds of other factors. But the bottom line is that their same-store sales are declining. So maybe they overbuilt. But I think it tells you that consumers are not doing great, but they're doing fine. And the point of that is that confidence can change quickly. The economy can change quickly. It's a very dynamic economy, meaning that little things can happen and have a big effect, and those little things are not predictable, right? We have an election, and everyone thinks it's predictable. Trump or Harris is going to win, it's going to be contested. That's what's going to happen. But it could be contested for 6 months. It could not be contested. It could be a runaway. And that president could get the mandate, and they could get the House and Senate. And there could be significant changes in the works, too. None of that is knowable. And that just holds true for confidence and the confidence of our employers. If they start worrying about the economy, they're going to lay people off. And that can have a snowball effect as well. So we have to basically take data as it is, and we look at companies like Starbucks. Tesla, I could care less about, just because it doesn't tell me much. They're still gaining a lot of market share. I think they're playing a lot of games with their books. They're telling us a lot of stories about the future and how Tesla cars are going to be everywhere and self-driven, and it doesn't register. But companies like Starbucks, Walmart, Target, those kind of Costco, Amazon, that's where we can get real data on the economy and what's really going on with consuming, with personal consumption.
That's right. And again, when and again, this is why I'm kind of anxious to see, Walmart, Target, some of these other retailers as they kind of start talking about forward guidance and, what they're seeing in terms of foot traffic and those type of things. And again, we're going to, as is always the case, when we get into early November, we're going to start seeing reports out from companies like Adobe that track, quote unquote, they track retail sales. But these reports are put out on the behalf of like the Retail Sales Federation, right, which are the marketing groups for, these retailers. So it's always optimistic. It's like the National Association of Realtors, right? Whenever you get housing data from the National Association of Realtors, it's always positive, right? It's always, housing is booming. But it's not necessarily the case when the actual numbers come out. So we're going to start to see some really rosy predictions. You're going to see some stories coming like, the retail is super strong. We're estimating $9.9 billion in sales over the Thanksgiving holiday, whatever it is. And then we'll get the real numbers. And when we get the actual retail numbers when they come out, I think we're going to see potentially a much weaker consumer than what, right now that a lot of economists are currently expecting. Because we've seen a lot of data out lately. The retail consumer is doing fine. They have a ton of pent up demand. They have a ton of money just sitting in the banks. I'm not so sure that's actually the case. And I think we're going to see that more clearly once we get into the, really post-Christmas. I think we'll see a much different story emerge.
Yeah, and I'm going to comment on one more comment.
Yeah.
Gold, the comment was something to the effect that gold is telling us that there's big problems out there. And I would just argue that we have one of the most restrictive Feds, and gold is really a bet against the Fed. And gold, we've said this before, gold is just being caught up in this speculative bubble. If you look at its correlation to the stock market, it is very high. So because gold is going up doesn't mean the world is coming to an end, doesn't mean the U.S. government is going to collapse, that we're going to default on all our debt. It means that people are buying gold because it's going up. Just like people are buying all these stocks that some of which have very little value, but they keep going up. So people jump into them. So, with gold, and I've been working on some data on gold and what drives gold. And the answer to what drives gold is different. It changes over time. And over the long run, what drives gold are economic fundamentals. And a lot of those fundamentals don't tell you that gold should be soaring. Doesn't mean it can't, doesn't mean it won't continue, but just be careful looking at gold as a barometer of the financial health and wherewithal. And it doesn't mean the government is going to default anytime soon. I promise you that's not going to happen, whether gold goes to 4,000 or whether gold goes back to 500.
And maybe next week, Mike, let's talk a little bit more about maybe get into gold, like what's the real value of gold? And it's, it's always great because, it's like, well, gold, we have fiat currency and, that means the world's going to go to bust. But maybe next week, let's talk about the value. What's the real value of gold? Is there something behind gold, or is it a psychological placeholder for value versus a fiat currency like the U.S. dollar, and what's actually behind that? So we'll try to remember, and we'll talk about that next week. All right, have a great day. Be sure and smash the like button. We appreciate it very much. Send your questions and comments, emails. Mike's article out on the website, and Richard and somebody will be here tomorrow for Financial Fitness Friday because Danny's out this week. So have a great day, and we'll see you back here on Monday.